Hi guys, welcome to another learning session. My name is Arjit and today we'll continue about stock market derivatives. In previous sessions or the part 1 of future and options concept, we spoke about the basic concept around derivatives and futures. So if you haven't covered that video yet, please cover that video before going into details of this video. So what are options? So most of you guys are familiar with how does an insurance work, right? Insurance buyer pays an insurance premium to get a guarantee of certain amount of cash that they will get if something goes wrong. On the other hand, options or insurance seller, what they do, the insurance companies, they collect those premiums for by selling those insurances. In options, contract also works almost similar way. So option buyers, they pay a premium for that kind of guarantee just like insurance. On the other hand, option sellers or options writer sell option contract and collect the premium. So if that something goes wrong, condition is met, option buyers gets the guaranteed amount just like insurance. And for option sellers, if something does not go wrong and if everything is fine, they just keep their premium in their pocket, which means that's how they benefit. So we learned about there is two type of market participant. Type of participant called option buyers and other of participant are option sellers. So options buyers is paying the premium, so they get a rights or that insurance we talk about, right? The guarantee. So option buyers gets that rights. On the other hand, the option sellers will have obligation if the condition are met. So if something goes wrong, options seller will have to pay the obligation. So before going into more details, let's learn some fundamental topics. Okay, so we spoke about in the previous video, we spoke about how does settlement works for futures. For options, there can be exercised in two ways. So options exercising mainly happened either in European style or American style. In American style exercise, you can do the settlement or take a delivery before the expiry, anytime before expiry. For European contract, it's allow exercising your contract only on expiry. So in our Indian indexes or Indian market, we follow an European style option exercising. So that means if you want to take a delivery or do a settlement, you have to wait till the expiry day. Expiry and lot size. So this is something we already spoke in the future session. The expiry and lot size basically will remain same for our contract series. So if a future has a monthly series, and then similarly option can also be in that same monthly series, and the lot size will be applicable same as the future lot size. For expiry, it could be a different series. So future may have a monthly series or option may have monthly, weekly, different series, as you have seen for Indian market Nifty or Bank Nifty, which has also weekly series. But conceptually, the idea of expiry and lot size is same as that we discussed on future video. Contract types and strike price. So in options, the tradable contract like option can be bought or sold by option buyer or option sellers in a specific predefined price, which is already predefined by exchange. So these are called strike price. So there could be two type of contract that could be traded in option. That is basically two type of contract that can be sold or bought. So there is call option or CE and put options or PE. Okay, so I mentioned that there is something called predator strike price that is predefined. So if you go to NSE India website and if you go under live market and equity derivatives, you will see there are some sample contract are there. So Nifty CE, Nifty PE. Okay, so this number, there is something called strike price also, right? So this is a call option or CE. So option type is call options and the expiry is this, and then strike price is this. So these three together is making one option contract. So it's called 11200 CE. So an option trader can either buy this or sell this. They can trade in this way. If I click on the option chain, we will go see something like this is for Nifty. So there is some column called strike price. So these are the predefined price that is already determined, like 50 rupees interval that is already defined, and these are the strike price. So which means the contract that can be created, it has to be in that strike price. So it has to be either 11250 CE PE or 11200 CE or PE, calls or puts. So that's how the options are defined, already predefined. Okay, so that goes for our strike price and the call option and put options. Okay, now understand what are these, what are call option and what are put options. So I mentioned that rights and obligation, right? Option buyer and option seller. So for call option or CE, there could be a buyer and a seller. For PE also there could be a buyer and seller. In both cases, buyer gets a rights or obligations. So the strike I mentioned, so if option buyer buys a strike and the CE contract or call options, that means if price goes above that price, the strike price, then the option buyers gets a rights to buy the underlying in the given strike price. Understand, this might sound a little bit complicated, but it is really not. Which means, let's say Nifty has 11200 and it is calls. So 11200 calls a call buyers gets a right if Nifty trades above 11200. So it could be 11250 or 11270, 260, any price which is above 11200. So call buyers will in that case will get a right to buy the Nifty into 11200 itself. So even Nifty goes to 11800, but they bought that 11200 C long back, which means they will be able to buy the Nifty in that price, 11200 strike price. Similarly, for put options or PE, option buyer gets a rights if price goes below that strike price. So 11200 is the strike price. If Nifty goes below 11200, it doesn't matter where it goes, the options PE option buyer will gets a rights to sell the Nifty in 11200, right? So they get a right. So they get a guarantee that they will be able to buy in 11200 or sell 11200. Okay, then if they get a right, then somebody has to write. Somebody will have to sell or buy in that price, right? So if price goes 11900, who will sell in 11200, right? So that obligation goes to the option seller. So the person who is selling the 11200 contract, they are supposed to sell Nifty in 11200 if price goes above 11200. Okay, so they gets the obligation to either buy for call or sell for puts. Okay, so if I just sum it up, C buyers gets rights, P buyers gets right to sell, right to buy if above strike price, if below strike price. So equivalent C sellers will have obligation to sell if above strike price in that strike price. Similarly, a P seller or put seller will have obligation to buy in that strike price. So they are basically giving you guarantee. If price go below 11,200, you can still sell your item in 11,200. So if price goes above 11,200, you are getting a guarantee of that you will be able to still buy at the lower price of 11,200. So that's how the options sellers giving you guarantee, and you are paying the premium because of that guarantee. It's almost similar as insurance contract. So I hope that clears up what options contracts are, and there could be 4 type of trade in options, basically either C buy, P buy, or C sell, or P sell. Now we'll see what will happen, but before that, what will happen if the market moves differently. But before that, let's talk about some of the terminology. Okay, so let's learn some more terms. So how is this premium value determined? So you are paying a premium whenever you are buying an options, right? So how is this premium is determined? So premium consists of 2 factors. One is intrinsic value, another one is extrinsic value. So intrinsic value and extrinsic value depends on 3 concepts, whether it's at the money, over the money, or in the money. So I mentioned previously that CE bias gets right if above strike price, right? So let's say you bought 11,200 in XYZ. Let's say you bought a 11,200 CE. So you are a buyer at 40 rupees. You paid a 40 rupees premium. Okay. Now, if current market price is 11,300, or it could be 11,100, or it could be 11, let's say 200. So which means price could be above 11,200, below 11,200, or at 11,200. Since you bought a call, if it's above 11,200, this is called, then your option 11,200 CE is in the money, or ITM in short. Okay. Now if the price goes 11,100, then 11,200 CE becomes over the money. If price is at 11,200 or near 11,200, it is called C is near the money contract. It's over the money contract or in the money contract. So there could be 3 scenarios. It could be either inside the money, or inside over the money, or it could be at the money. So this is for C. What happens for P? It will exactly be opposite. So if you bought a 11,200 P at 50 rupees premium, bought 11,200 PV at 50 rupees premium, which means 11,300 when price is, in that case 11,200 PE is over the money, because the price is above the strike. If price is at 11,100, this means 11,200 PE is in the money. See how for call options buyer and put options, the in the money and over the money becomes exactly opposite, right? So price is below strike for put options, it will be in the money, and price is above strike, that is over the money. Similarly, if price is at the strike, so it will call at the money or near the money. Okay, so what is in the money, over the money and at the money is clear. So I mentioned there the price premium is consisting of two factor, intrinsic value and extrinsic value. So in both cases, when price is at in the money, which is price is at in the money, in that case the difference between your price and the strike becomes intrinsic value. So price and strike difference, right? So for in the money, it has to be for in the money. So for 11,200 PE, if price is at in the money, which is 11,100, let's say, then the difference between 11,200 and 11,100 is equal to 100 rupees. So intrinsic value for 11,200 PE become 100 rupees. Similarly, 11,300 minus 11,200 is equal to 100 rupees is equal to intrinsic value for 11,200 CE. So for 11,200 PE, 100 rupees is intrinsic value if price is at 11,100. If price is at 11,300, which is in the money for 11,200 CE options, then difference become intrinsic value. So this is intrinsic value. So extrinsic value, the remaining part of the premium you pay as a extrinsic value. Okay, so which means if we go back here, you will see that price or last traded price, whatever is different. 11,200 price is 109 rupees right now, it's showing. So let's say currently 11,200 C is at 110 rupees price. Okay, but what was the latest Nifty price? The latest Nifty was 11,217. So 11,217 was the latest price. Okay, so how much is intrinsic value? Because 11,217, which means 11,200 C is in the money. So difference between 11,217 and the strike 11,200 is equal to 17 rupees. This is intrinsic value of that option contract, which means it's trading at 110 rupees. So 110 minus 70, which is 93 rupees, is equal to extrinsic value. So you are paying a premium of 110 rupees with 70 rupees intrinsic value and 93 rupees extrinsic value. Now the factor intrinsic value is quite simple, that difference between the strike and the current last price is the intrinsic value. Extrinsic value depends on multiple factors. So it depends on events, speculations, volatility. So all these factors affect how much extrinsic value can be. And in another video, how to use an option calculator, I mentioned there is something called Black-Scholes calculator. So Black-Scholes calculator calculate these values and give you what's the fair price or what is the fair premium for an option contract at any point of time. So that's how that fair price could include intrinsic value and extrinsic value. Okay, so intrinsic value and extrinsic value we learned. For in the money, intrinsic value will be there. For over the money, if the price is over the money, there is zero intrinsic value, which means entire value is extrinsic. So if 11200 there is 11300 C contract or 11250 C or 11350 calls, all these call contracts are over the money. So these all contract, the value last traded price includes zero intrinsic value, so entire amount is extrinsic. Similarly for put, 11200 put options is over the money, or 11200 is at the money because it's near to 11200. So at the money also it does not have any intrinsic value. So which means we'll only have intrinsic value for in the money option, and for other options we'll only have extrinsic values. So in the money option can also include an extrinsic part, so the value of in the money could be additional to what intrinsic value is. So fair price calculation we covered in another video called how to use an option calculator. So that's how you can calculate what will be the fair value of the option premium. Okay, so like you compare three insurance company and who is giving you a reasonable price. Similarly, you use the option calculator to get a what is the fair price that you should be paying for a premium. Okay. Now, so we understood over the money, in the money, at the money, and the value or premium, how they are get related to intrinsic value and extrinsic value, right? So one more thing we spoke about earlier, right? So we talk about rights and obligations. So if the money is in the money, in that case that rights is applicable, which means like I mentioned, C buyers gets a right if the above strike price. So for call option, if the price is above strike price, then it is in the money, which means in case of it's the condition is it has to be in the money for options buyers to get rights. So if price expire, if the contract expire at over the money or at the money, options buyers get no rights, which means like insurance, if nothing happens, what happens? The insurance company just keep the premium in their pocket. So same thing happens for over the money, at the money option. So if expiry happens over the money or at the money of the contract you bought, then it goes to the pocket of the option sellers or option writers. So that's how the rights and obligation thing works out for both. Open interest. So we spoke in future, the previous part 1 video about future open interest, right? So when a buyers and sellers agree to a contract, it creates one open interest, and total interest, that is total sum of such contract in the series which are not expired or not squared off, basically open, those contracts are sum of those called open interest. So for future we had only linear open interest, right? So depending on sell position or buy position, it's a total sum. For options, the open interest could be different. For option open interest, it could be sum of call open interest, sum of put open interest. So that could be call open interest or put open interest. There could be open interest based on strike. So if that strike is different, so how much contract opened in the strike. So the call open interest and put open interest will be here. So this is call open interest and this is put open interest for that strike, and cumulative open interest for call will be sum of all open interest, which is the total. So that is total cumulative call open interest and total cumulative put open interest. So as you can see, for options, the open interest is a little bit different than future. So we'll talk about how you can use this open interest data as a support and resistance indicator, and or how to analyze where market can head to. So market directions kind of analysis or the support or resistance kind of analysis can be done using the open interest of calls or puts. So this thing is called option chain, which also gives us data about open interest and other things. We are going to talk about how to read option chain and how to analyze market based on the option chains, where I will include this topic, support and resistances. Okay, so let's talk about buyers and sellers, right? So we talked about options buyers and options sellers. So just like insurance companies, right? So they are like a company, and what options buyers happen? Who are the insurance buyer? Like individuals mostly, right? There could be company who buys in bulk insurance, but mostly you can think about one insurance buyer is basically an individual, and whereas sellers is a big organizations. So similarly for options writers or options sellers are normally a big entity or a trader with bigger capital. So for option selling and option writing, it's normally take more capital, even though some of the broker house they probably provide high leverage, but without having good enough capital, option selling could be very risky, and option selling could also be very quite complex as the risk need to be managed efficiently. So like in previous chapter, if we say the option buyer gets right and option seller gets the obligations, right? So which means if price can go above a strike price for call option, the price can actually infinitely go above, right? There could be no stop. And the intrinsic value that will be for, let's say price goes very high, 12,000, and you bought 11,200, so you basically get intrinsic value of 800 rupees. Now so that much big move can happen, or it could be 13,200, sorry 13,200, the price goes to 13,200, then this is like 2,000 rupees intrinsic value. So entire intrinsic value, if it happens to be on expiry, the option seller has the obligation to pay that amount. So how is that profit calculated here? Basically the difference, the intrinsic money value into the lot size. So let's say this is Nifty, so Nifty has a lot size of 75, so this will be the profit for option buyer, but at the same time, since it's a zero sum game, option sellers will have to pay this amount, so which means this will be the loss for option sellers. Since price can go unlimited amount of time above, so options sellers can have unlimited loss and options buyer can have unlimited profit. But hold that thought that options buyers can have unlimited profit and option sellers can have unlimited loss. So that's one reason the risk need to be managed very efficiently if you are trying to sell options, so that you don't incur a big loss. So that is why it is option selling is done by much more professionals or bigger trader. Okay, so that's how the role of option buying and selling changes. Okay, but that is not all. Now, because a lot of people just go and buy options because they think they can have unlimited profit, but think about reality, right? In reality, price may not move to 15,000 or 16,000 in 1 month or 2 months, right? So that's the reality, which means people get trapped buying over the money options and then thinking that they will make big profit, and it doesn't happen. Why? Because if price remains below the strike they are buying, they lose all the money that they paid premium for. So entire premium gone to option seller's pocket. Okay, how the price moves of options are determined by something called, so this part of the again the option price calculations, but it's much more a little bit advanced topic. So how much option price will move per rupees movement of the underlying, that is defined by something called option Greek named delta, and the option premium, the extrinsic value part that I mentioned previously. So if any option contract has an intrinsic value, extrinsic value, and this extrinsic value is decay or lose the value, it lose in value over the time. So time is a factor. Soon the nearer to it gets to the expiry, the price of the extrinsic value part becomes slowly near to zero. So it start with a big amount, then it slowly become near to zero, and it becomes zero extrinsic value on expiry. So the amount that is decaying because of the time, that is measured by another option Greek called theta. So there are other option Greeks as well. So we are not going to cover option Greeks in this sessions because it's a little bit advanced topic. But we just thought that I would mention it for your curiosity. Okay. Now what happens, we mentioned about option buyers can make unlimited profit and option sellers can make unlimited loss, right? So what happens in case, so spot price or underlying price of the contract is already moving. It can either move up from current positions, it can go down, or it can stay in the same range or near to the current price. So if I were to consider Nifty or any other stocks, so current price is this, that is truth. So price can either go above this, go below this, or stay in this price. So there is only three possibility. So in case option price goes up, the strike price that the call option buyers win. If price goes up, then also put option sellers win. So put option sellers, let's say somebody sold a put at 11,200 and price goes up, which means the 11,200 become over the money and the extrinsic value on expiry will become 0. And somebody bought 11,200C, if price goes up they will make profit. So both of them, the P option or put option seller or call option buyer, both wins. If price goes down, then put option buyers wins or the call option seller wins, which means if price goes below 11,200, then the person who bought the 11,200P, his contract will go in the money and hence he will win there, he'll make profit. And if price goes below 11,200, the 11,200 call seller who sold the call contract, because call contract in that case will become over the money, and over the money will have zero intrinsic value on expiry, hence the win will be for the person who sold call option. So if price goes down, call option seller and put option buyer will benefit. If price stays in the range, so if price stays around 11,200, what will happen? If 200 call buyers or put buyer, the current price is also include an extrinsic part. So all the extrinsic part will become 0, which means the premium you paid for the intrinsic value is only little, right? So for 109 rupees you paid only like 17 rupees intrinsic value right now. So rest of the value will become 0. So price will fall down, and so in that case both option seller, put option seller and call option seller will win. So if price stay in range, put option seller and call option sellers both win. So if you calculate, just count out of this all the possibilities, 1, 2, 3, 4, 5, 6. Out of this 1, 2, 3, 4. In 4 cases out of 6 cases, as option seller is winning. So which is like two-third of all possibility, which is 60% possibility, 67% around possibility that option sellers will win. And there is only 33% probability that option buyers will win. So now that we revisit the fact that option buyers can have unlimited profit, but only 33% of chance. Now option sellers can have unlimited loss, but only 33% of chance, which means remaining 67% chance of win. But option sellers only collect the premium amount that you paid for, right? So which means their profit is limited. So option seller collects the premiums, which is limited profit. Okay, so but since the probability of win is more, even with limited profit they will be able to make profit. And even on 33% cases they can manage their risk professional way, where they can reduce the unlimited risk to a limited risk. So there are different option strategy that they can deploy where this unlimited loss become limited loss. Okay, so they increase the probability with limited loss, then it become a profitable for option seller. But since it's complicated and it requires quite a bit of capital. So I hope understood that 2:1 equation here, or 67% equation. So we mentioned that this is something we'll probably cover again in the option chain video on the next part of this. But here is something that we already discussed in future, that if open interest increase, price increase, and then there's a long build up, open interest increase, price decrease, there's a short build up. The similar way options will also have the same thing, except now options does not have on single factor. Options can have call option and put option, which means the increase in open interest can lead to a different meaning, and decrease in open interest will lead to a different meaning based on whether the open interest is for call or whether open interest is based on put. Okay, so this is one of the thing that I shared earlier, that all the possibility or market cycle that can happen from any point of time. So whatever was the immediate previous trend, based on that there could be uptrend, and after uptrend there could be a resistance found and consolidate, or it can found a resistance, it reverse from there, from uptrend to it become downtrend, or the price resistance, it give a breakout at resistance and price continue upward. Similarly for downtrend it will happen in similar manner. So when the price is consolidating, in all the cases options buyers will lose the value of the premium slowly over the time because of theta decay, and on expiry the premium will become zero for all over the money at the money contracts. So which means in cases of when price is actually moving, whether it is going up or down, in only those cases you should be choosing to buy an options. I hope this makes clear on what are the options and what is the scenario when you should be buying an option. So when you are expecting a move, then only you are looking for buying an options. Otherwise, in other cases, if you buy an option, it will only lose value and you will make a loss. So I hope I clarified most of the concept that are related, basic concept that are related to options. So if anyone has any questions, like a part of it which you don't understand or you did not understand despite I just explained, or I may have gone a little bit faster than I was supposed to be, in that case please write your comment with your questions. I'll be happy to answer. Okay, so options instrument are vast topic, so whatever I covered here is the basic and is for absolute beginner. So it will give you a basic concepts, which means if you want to trade regularly in options you should be learning more details. And on the next session we will be talk about option chain and analyzing the option chain, how to use that as part of your daily analysis. But apart from that there are option Greeks, and so there are options Greeks can be very vast topic. So I suggest if you understood the basic, go ahead and read the next topic and gain more knowledge. So we'll continue this in the next part about options more. Do feel free to like, subscribe and take care.